Have you ever been presented a whole life insurance policy? You're interested in cash accumulation, maybe the death benefit long term, but you're shown one option with one company and one design, and you look at it and think, are there other options? Can I see different companies? Can I see different products? What does it look like if I pay the same amount of money in, say it's $10,000 per year, whatever the cash flow is, but put less towards the premium? What if I put more towards the premium? Can I consider a different company so I can compare and contrast? Because I don't want to be shown one option and then find out after the fact another option exists that I would have gone with, but Steve, you never showed it to me. I think everyone feels like that in the industry, or at least when they are first shopping for a policy. I know I did. I was that guy that said, hey, I want the details. I want to understand it so I don't find out after the fact something else better existed. It doesn't have to be perfect. I don't have to see every bit of information out there, but I want to see enough information so I can make an informed decision and then execute it. So one example is products and companies. There are a lot of different companies out there, a lot of different insurance products. What are some of the differences? Well, a couple quick examples here. If you are shopping for a policy, and maximum cash value is your goal, and perhaps flexibility, what are some checkpoints we should consider here? Well, number one, with the insurance company selection, a lot of insurance companies exist. We have found that certain companies have consistently delivered the strongest actual cash values to policyholders. Those companies are MassMutual, Guardian, New York Life, and Northwestern Mutual. Up on the screen, you see their 2021 dividend interest rates. What I will add about dividend rates is they're good for the here and now, but as time passes, you will see that any of those companies tend to go back and forth with each other as far as who illustrates the strongest values, who produces the strongest actual cash values. They all tell you that they're better than each other, but when we look at the actual data, we see that they tend to go back and forth over time. So quality carriers there, all massive, but again, the biggest selling point, in my opinion, of those four companies is when we look at real cash value policies that have lived the test of time. Not just an illustration, not just a projection that looks good, but real policies. Those guys have delivered. Some smaller companies have as well, but we've got the most data from those top four. Step two, flexibility. So when it comes to a cash value life insurance policy, typically we think what? If it's just an insurance policy, I pay a premium, it's a flat bill, I pay the same amount every month, every year, and it can be a bit boring. I'm committed to premiums. I don't want that. The question is, how do we turn that policy into a flexible savings asset where I can adjust my payments and such? Well, you can absolutely do that with a policy. Often, individuals will talk to us and say, hey, Steve, I want the ability to pay $100,000 per year into a policy, but I do not want to get a bill for that. How do I set the policy up where it is very flexible? Well, you can easily do that. We always refer to the 10/90 split, where we can have a 10% premium. A lot of companies will allow you to do that. Some actually let you go lower. But let's say I've got a 10/90 split with a $10,000 base premium. I can commit to that and then have the ability, not commitment, but ability to go up to $100,000 per year. And I can vary payments as time passes. I can stop early, kind of like the example you see up here on the screen. Funds for a short period of time, but payments vary over time. He's not committed or locked into any premium payment, which is nice. Now, when it comes to the flexibility, this is an important piece of information. Some companies will allow you to adjust payments at leisure. So a couple quick examples. We listed those top four companies. I'll give you two quick examples. MassMutual, if the policy is set up properly, is a company that will allow you to adjust your payments one time per year, every year, on your policy anniversary date without any medical underwriting at all. You can make it a bit more flexible than that as well with some new riders they recently came out with. However, where MassMutual works very well is if a policyholder is comfortable and disciplined to make a one-time per year payment adjustment. So for example, I can pay in $10,000 year one, $30,000 year two, $50,000 year three, then back down to 10. I can bounce it up and down, no medical underwriting, one time per year adjustment on my policy anniversary date. Another quick example, Guardian, very flexible. Guardian is a company that will allow me to commit to the minimum premium. So going back to that example we mentioned before, with the ability to go up to $100,000, but only commit to $10,000, well, what we could do here is easily commit to the minimum $10,000, pay just that annually. You could even break that up over 12 months. And then 100% at your discretion, you can log on to an online portal, you can go on your mobile app, you can send in a check and just dump money into PUAs. Very, very flexible in that respect. So those are two quick differences in terms of flexibility with two of the top companies. Of course, it's good to know information on any company or companies we are considering, but two quick examples there. So hopefully you found this helpful. If you have any specific questions or would like to see personal samples yourself, feel free to reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.